Okay, I welcome you all to FCL Accountants Tuition Center YouTube channel. Luando Franklin is my name, the Chief Executive Officer at FCL Accountants Tuition Center, as well as a lead tutor. The tutor with vast experience in lecturing and training accountants, over 20 years of experience. In today's video, we are looking at transfer pricing. We'll look at the objectives of transfer pricing, that is the advantages. We'll also look at the division operating at full capacity and the division operating at excess capacity without alternative use and also with alternative use. And then we'll go into the calculation of the transfer pricing price on each of the circumstances at full capacity and at excess capacity. This video is relevant for students doing SCCA, performance measurement, and also those doing advanced performance measurement, and those doing a degree in accountants course, and those doing also CIMA. So get started. So I'll start by defining what is transfer pricing. Transfer pricing, which is TP, abbreviation. Transfer pricing is the price at which a component or a service can be transferred from one division to another division within the same organization. That is transfer pricing. And now, what are the benefits, or rather objectives of transfer pricing? Advantages. So we have the advantages, which are objectives or benefits. Transfer pricing, number one, transfer pricing promotes goal congruence in the organization. Promotes goal congruence. Promotes goal congruence. This simply means the divisional manager. The divisional manager's interest is in line with the interest of the organization as a whole. The divisional manager wants to earn a bonus. That bonus will only be earned when he achieves the target set by the organization. So the divisional manager works hard towards achievement of that target for him to get a bonus. And the target could be profit maximization, which will also move towards the interest, or rather the objective of the organization. Number two, transfer pricing helps to reduce global tax liability, where the organization has divisions in different tax jurisdictions. In order to reduce the tax liability, divisions with higher tax rate will transfer the components to the divisions in a lower tax jurisdiction and be able to sell to the external market and thereby paying less tax. So help reduce global global tax liability. That is okay now. The other advantage is An ideal transfer pricing promotes autonomous in the divisions. Promotes autonomous. Promotes autonomous. Autonomous in the divisions. What does that mean? This simply means the head office does not interfere with the setting of prices. It also means the transferring division can sell to the external market. It has a right to sell to the external market. It has a right to set its transfer price. The receiving division also has the autonomy to make decisions where to buy. They can also buy from the external market. That is, promotes autonomous in the divisions. In number 4, an ideal transfer price will help performance measurement in the divisions, will help performance measurement in the divisions. This will enable both the transferring division and the receiving division to earn their bonuses. So it helps performance measurement. Performance measurement. Number 5, I want you to understand that number 5, an ideal transfer pricing will help the organizations, or rather the divisions, to keep track of the movements of goods and services within the organization. To help keep track of goods and services within the organization. Within the organization. So basically, these are the objectives or the advantages of transfer pricing in the organization. We can now go to the measurement. I want you to pay particular attention. We have 2 situations. There is one. The transferring division is operating at full capacity. Operating at full capacity. What does that mean? Operating at full capacity means that all the units that will be produced by the transferring division will be bought by the external market. That's what it means, operating at full capacity. So operating at full capacity simply means all the units that will be produced will be sold in the external market. If that is the case, then the transfer price will be at the market price, less internal savings. The internal savings here refers to the cost that will be avoided because you are transferring within the organization, such as transportation, advertising, and bad debts. Those will be eliminated. Therefore, if all the units of the market, they'll be transferred to another division at the market price, with less internal savings. Market price, less internal savings. And this is what we call adjusted market price. Number two situation is where the division is operating at excess capacity. Excess capacity simply means the units that will be produced, not all of them will be absorbed by the market. Therefore, there will be some units which do not have the market. If that is the case, then the units without the market will be transferred at the variable cost of production. Variable cost of production less internal savings. Less internal savings. Actually, this situation is operating at excess capacity. Excess capacity without alternative use. This excess capacity, there is no alternative use. Without alternative use. So where the transferring division is operating at excess capacity, they have spare capacity. So the units to be produced, not all of them as the market. The ones without the market, actually, they'll be transferred at the variable cost, less internal savings. And this is where the spare capacity has no alternative use. Is that okay now? Then under the same, we have excess capacity with alternative use. Excess capacity with alternative use. Excess capacity with alternative use. With alternative use. Now, where the excess capacity has alternative use, the transfer price will be at variable cost of production plus the lost contribution from the alternative use, less internal savings. So here we have transfer price will be variable cost plus lost contribution from alternative use, less internal savings. So basically, that's how we determine the transfer price. Now we are going to look at the question, which I'm sharing on the screen there. Test your understanding 8 additional example. Now, before we go into the question, where the cost of production is not given, cost of production is equal to selling price less gross profit. That is very important. So now the cost of production is the makeup of fixed costs and variable costs. The fixed costs are not relevant for decision making, or rather they are irrelevant for decision making purposes. So we only get the proportion of the variable cost. So now the examiner may use the terms markup. Markup is the gross profit on cost Markup is the gross profit on cost. Margin is the gross profit on sales, selling price. These two terms are very important. Markup is the gross profit on cost. Margin is the gross profit on selling price. So if you are given the markup and you are not given the gross, you are not given the cost of production, you need to change the markup to margin. Let me just share with you how you change it. When you are changing markup to margin, you have the markup. So for example, if the markup is 20%, it will be the same numerator upon 100 plus the numerator. That will be margin. Very important. When you are changing markup to margin, for instance, if the markup was 20%, you want to change to margin because you are not given the cost of production, it will be the same numerator, 100 plus same numerator, and this will give you 20 over 120. If you have the margin, but you are not given the sales, so you need to change the markup. You need to change to markup. Change it, for example, if the margin was 25%, to change to markup, it will be the same 25% numerator, 100 minus numerator. So there it will be 25 upon 75. That's how you work with these markup and margin. So now let's look at the question. Manuka company has been offered supplies of special ingredient Z at a transfer price of 15 per kilo by Helpco company, which is part of the same group of companies. So that is a transfer price. Helpco processes and sells special ingredient Z to customers external to the group. So there is external market at 15 per kilo. Helpco bases its transfer price on full cost plus 25% profit markup. So this is markup. So we don't have the cost of production. So in order to get the gross profit and deduct it from the selling price, in order to get the cost of production, we need to change the markup to margin because margin is on the selling price. The full cost has been estimated as 75% variable, 25% fixed. So we need to know what was the production cost so that we can take order of the variable cost, which is relevant for decision making. Internal transfers to Manuka would enable 1.5 per kilo of variable packing cost to be avoided. That is internal savings. So now, before we can get started, we must be able to find out what was the variable cost. So we have the selling price. Selling price here, which is 15. What we are given is the markup. Markup, you can't use it on the selling price. What you need is the margin. So we change the markup to margin. So margin will be same numerator, 100 plus, that's what we said. So this fraction, which will be 25 over 125, multiplied by 15, that will give us the gross profit. So the gross profit there is 3. The gross profit from the selling price will give us the cost of production. Cost of production, we have, then we are told 75% is variable cost. We are interested in the variable cost. So the variable cost there is 9. Now we go to the questions. Discuss the transfer prices at which HelpCo should offer to transfer special ingredient Z to Monaco in order that group profit maximization decisions are taken in each of the following situations. HelpCo as an external market for all its production of special ingredient Z. Now we have discussed. So this simply means since HelpCo is operating at full capacity, that is, it has the market for all its production, the transfer price will be at the market price less internal savings. So this should be at 13.5. And this will be referred to as adjusted market price. That is the answer to question 1. Then we go to question 2. HelpCo has production capacity for 9,000 kilos of special ingredient Z. An external market is available for 6,000 kilos of material Z. So here, since HelpCo is operating at excess capacity of 3,000 kilos, the transfer price will be variable cost less internal savings. We have the production of 9,000 kilos less 3,000 kilos. The kilos there are 6,000. Yes, the market 6,000. Then excess capacity will be 3,000 kilos. These 3,000 kilos will be transferred. Transfer price will be the variable cost, 9, less internal savings. So the transfer price here will be 7.5 per kilo. Now we look at the other question here. The other question, which will be HelpCo has production capacity of 9, has production capacity for 3,000 kilos of special materials Z. An alternative use for some of its spare production capacity exists. This alternative use is equivalent to 2,000 kilos of special ingredient Z and would earn a contribution of 6,000. There is no external demand. So here, HelpCo is operating at excess capacity with alternative use. Therefore, we need to determine what is the contribution per kilo for alternative use. So there, question 3. Question 3, there we have contribution per kilo will be total contribution divided by 2,000 kilos. So here it will be 3 per kilo. Now, the transfer price for excess capacity with alternative use is the variable cost. Is the variable cost 9,000, so the $9. plus lost contribution, 3, less internal savings, 1.5. This will be 10.5. So which means the 2,000 kilos, which has alternative use, will be transferred at 10.5. The 1,000 kilos have no alternative use. These will be transferred at variable cost, less internal savings, and this will be 7.5. So we have looked at the transfer pricing. Therefore, for today, we can end here. On behalf of FCO Accountants Tuition Center, we want to thank all our subscribers, both those who have just joined and those who are existing. For those who have just joined, please remember to hit the notification button so that you are able to receive immediately when new videos are available. Thank you again, and God bless you.